Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Joe Cavatoni. He's the chief market strategist of North America at the World Gold Council with his outlook on the macroeconomy. And of course, we will focus on gold. Joe, it is great to have you back in studio. Welcome back to Trade Talks. And of course, the obvious question is, what are your thoughts around gold performance with ongoing inflation and potentially a recessionary environment that might be a little bit more prolonged than the market thinks it could be?
Great question. It's best to start by talking a little bit about what we saw in 2022. The early part of 2022, we saw a strong performance of gold brought on mainly by geopolitical risks, the Russian invasion in the Ukraine. Throughout the remainder of the year, it was all about a story about monetary policy, how the Fed and other central banks were moving rates to taper concerns and risks of the inflationary environment. That proves to be a headwind for gold, and that's exactly what we experienced at the tail end of last year. Now, what we're going to be seeing into 2023 is an environment where that type of behavior, that inflation control by these central banks, is going to slow down somewhat. That's what the market consensus is guessing is going to look like to possibly happen. And what we're going to start to see now is gold playing a more pronounced role in portfolios and the performance, which we've got obviously the beginning of the year in a strong performance, but our expectation is if it's a severe downturn in the economy or a mild downturn in the economy, the factors will play in well for the performance of gold.
Right.
If we can stick a soft landing, I think that would be kind of one of the worst environments for gold. It wouldn't be a bad environment, but it wouldn't necessarily mean assets would flock to that safe haven performance that gold gives you. What you would have there is a more risky appetite, an appetite for risk assets, I should say. And so that would be an environment where gold would probably have a flatter performance. Right now, our expectation is we're looking at the potential for a recession, and in a recessionary environment, like 5 of the last 7 we've seen, you see that the performance of gold is strong. Why? Because people save in that kind of an environment, and the safe haven asset that it is what it becomes, and that's what it does.
Right, and it was interesting, we were talking off camera before about the market either hoping for a little bit of a taper or a quick reversal of Fed policy. What are your thoughts around that? They seem to be telegraphing that they're not going to taper anytime soon.
I think it's hard to tell. We don't have a crystal ball, and what we basically are expecting is that we're going to look for those severe or maybe that mild kind of environment to develop. That's the more conservative position to take right now, and that's probably the safer place to play. And that's why when you look at what people are going to be doing with their assets, they're rotating into gold. Now, in a moving environment, an inflationary environment, that's when people are looking for opportunity cost. And they're looking for where to put their money. Momentum plays into it. Short-term tactical factors. Those are what causes that concern and that pressure against gold as an asset. But once it starts settling in and we see more stabilization around rate moves, and maybe this is taking a longer time to play out, that's when it plays and strongly plays into the portfolio performance. You see returns of 4 to 8% in each of those 5 times when we've had a recessionary environment, and that's the kind of expectation that we could have for 2023.
How is bar and retail investment demand influencing what we're seeing in the market?
This is a great question. At the end of this month, we release a quarterly review of all the demand that you can see for the gold market and the supply side as well. Now, a lot can be seen in like the published markets of like COMEX net positions, which are net long right now, which is a very interesting signal for gold position. You can see ETFs and you can hear about central banks. But we produce this report, and we really want people to focus on it at the end of the month because it's going to show a lot of really telling signs of what's really playing out in some of these developed markets. For example, in the US, I think we have 2022 was one of our strongest years since 1999 in terms of retail coin and bar demand. This is people buying it for investment purposes, saving it in the form of bars and coins. You don't see these numbers on an exchange or anywhere. Right. You see this in Europe as well. Germany had a performance that was very strong in terms of demand, and you see that these pockets of retail consumption of gold provide a huge amount of demand and a huge amount of consumption, which is what's been giving us price appreciation. In addition, there's a bit we'll talk about probably on central banks, but when you see these retail firms that are selling and these consumers buying, this is the stuff that's actually keeping that price up. It's like savings, investment, and record-setting levels of consumption amongst consumers. Now that's ignoring jewelry and China and India. If you add that kind of activity in, you're going to see strong performance. And China's another factor that's going to come online in 2023.
So why are they buying coins and bars? Wouldn't it be more efficient to buy an ETF? Is there any read-through there?
Not for everybody.
Yeah.
There's something about the fact that physically owning gold appeals to people.
Yeah, well, I mean, you don't own physical stock certificates anymore, so maybe, I don't know,
Well,
maybe it's just, physically
You know what?
holding that.
It's a great point. A lot of the work that we've been doing at the World Gold Council in coordination with organizations like the LBMA, the London Bullion Market Association, is to look at what can we do and how can we help through our Gold Bar Integrity Program, as we call it GBI, to digitize gold in the future. And that's a big body of work. We're starting with trust and transparency.
Right.
Got a few firms that we're working with to track gold in its physical form. But how can we make sure that people still feel comfortable and confident, trust it, know that they could have it in physical form, but could use modern technology to get access to it? The ETFs are fantastic. There's 85 instruments worldwide. People hoover them up like they should. But it's not necessarily for everyone.
Right.
And people still like the idea of holding it in physical.
All right. Well, what about central bank demand? You had mentioned that earlier.
This is a story that everyone needs to pay attention to. For the last 10 plus years, emerging market central banks have been buying gold. And that story has continued pre, during, and post-COVID. And it's actually pre and post the sanctions being implemented on Russia. This is a story where you're seeing central banks finding the value of gold, diversifying their reserve currencies to own it in their portfolio. And it's really a fascinating story. We saw large numbers of coming in throughout the quarter four in 2022 of demand that's basically being picked up. China has been releasing through official channels that the PBOC is purchasing gold. This is a story to watch because it's going to be one of the four categories: jewelry and consumables, investments, central banks, and technology. One of the most important ones to watch for 2023 as they continue to put gold in their portfolio.
Interesting. All right, Joe, we appreciate the insight as always. Thanks for joining us on Trade Talks. Thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.